All right, so it looks like almost everyone is back. So we'll get started with the GASB update. So this year, only one new GASB in addition to what we covered last year. So just GASB 104 was issued recently. So today we're gonna get started here. We have two standards that are due for fiscal year 25. GASB 101 regarding compensated absences. GASB 102, certain risk disclosures. Next year, 26, we have two also. GASB 103, oops, not compensated absences. I thought I corrected that. Financial reporting model improvements. And GASB 104, certain disclosures of certain capital assets. So these are the four new GASBs that are issued and are out there. So we're going to start by GASB 101. We're probably going to spend some time since this is the implementation year. So we can get started. So it's effective for fiscal year 25. Keep in mind, if you're on a calendar year, it's actually effective for the fiscal year December 2024. So I do have one client who is on a calendar year, so they are implementing it for December 2024. All right. So compensated absences is a leave for which employees may receive one or more of the following. Cash payments when the leave is used for time off, when someone takes vacation or takes a sick day and they're still getting paid their salary. So that's basically they're getting paid a compensated absence. Other cash payments, such as payment for unused leave upon termination. So when somebody is retiring or someone employment terminated and they're getting paid their unused vacation or sick leave balance. And then also the non-cash settlement, such as conversion to defined benefit post-employment benefits. So we see that quite often where the unused balance can be converted to CalPERS service credits or other type of benefits. So that is also will fall under the compensated absences. Examples of compensated absences, you have vacation, annual leave, sick leave, PTO, holidays, parental leave, bereavement, certain sabbatical. I mean, I don't want to say this is all inclusive. These are just examples. The idea is that you want to see any kind of leave that meet the definition of whether it's for past service, whether it accrues, and whether you would be getting paid for it either in cash or non-cash. Any type of leave that meet those definitions will fall under compensated absences. So it doesn't have to be called vacation or PTO. It can be called anything else. As long as it meets those criteria, it is a compensated absences. So sabbatical leave, sometimes you have unrestricted sabbatical, meaning that the employee is not performing any duties when they are on sabbatical, and that is compensated absences. But if you have sabbatical where the employee is performing alternate duties or different type of duties, then that's not really compensated absence. So for example, if you have an employee and is doing research instead of teaching, so that's really not going to fall under compensated absences. Right. So as far as recognition and measurement, so a liability should be recognized for the following. Leave that has not been used. I would say that probably most of your liability, if not all of it, would be in that leave that has not been used. The balance of vacation and sick leave and all of that has not been used yet. Leave that has been used but not yet paid or settled. That's kind of like payroll accrual. Basically, somebody took vacation, but you haven't paid them yet. Well, you haven't paid them because probably the pay period is not due yet. So that is considered to be compensated absences. And honestly, that liability, you're not expected to, like it would most likely be already part of your payroll accrual. So there will be no additional liability that you have to record for that leave that has been used. And then applicable salary-related payments. So salary-related payments, we're going to talk more about it, but this is basically everything else that you have to pay when you liquidate those vacation and sick leave. So FICA, Medicare taxes, contributions to like a 457 plan or a 401A plan, anything that normally goes with the salaries, that goes with paying people when they go on vacation, needs to be part of your liability. So it's not just as simple as hours times rates, but you also have to add all these other related payments. So let's talk first about leave that has not been used, which again, that's most of your liability, if not all of it. So a liability should be recognized for leave that has not been used if all of the following are true. The leave is attributable to services already rendered. So not something in the future, but service already rendered. The leave accumulates, so it's not use it or lose it. And also the leave is more likely than not to be used for time off, paid in cash or settled in non-cash. So more likely than not is more than 50%. GASB have definitions or they use terms that throughout all the GASB literature, they use either probable, reasonably possible, or remote. Probable means it's likely to occur. Reasonably possible meaning it's higher than remote, but it's less than likely. And then obviously remote is remote. So in this case here, they didn't use any of these terms. They said more likely than not. So basically, I interpret that as more probable than not. And they said, because probable means likely to occur. So they said if it's over 50% chance that this is going to happen, that's what they mean by more likely than not. So that's important because that's really big part of your calculation of compensated absences is to calculate what's more likely than not that we're going to have to pay. So it's not automatic that's an employee who earned 100 hours of vacation. It's not automatic that you're going to have 100 hours of liability. You're going to have to calculate what's more likely than not for us to pay those 100 hours. And we're going to talk about what does that mean, how you calculate that. So if you have a leave that is attributable to previous service or service that's already been rendered, if it accumulates and if it's more likely than not to be paid, then that's a compensated absences and that's what you're going to be recording. How to evaluate whether the leave is more likely than not to be used for time off, paid in cash or settled in non-cash by assessing the following. Employment policies, whether leave that has been earned or will become eligible for use or payment in the future. Historical information about the use of or payment, which I think is really the most important part is the historical information. And then information known to the government that indicate that historical information may not be representative of future trends or patterns. So historical information is what we see most entities doing, is to calculate what's more likely than not. They're looking to see what are our history, what are our utilization rates, and so on. So if somebody, for example, have 100 hours of sick leave, you don't automatically put 100 hours liability. If you don't pay for sick leave when an employee terminate, then your liability really should be what you think the employee will utilize as sick leave. So how do you come up with that? You look at prior history to see, well, what was the utilization rates in the past? And then you look at that last bullet point and say information about known to the government that would indicate that historical information may not be representative of future trends. So for example, if you look at the last 5 years of history, well, those include some COVID years. So that may not be representative of what's expected to happen in the future or future trends. So you want to take that into consideration. I personally think 5 years is a long time to go back for sick leave. Maybe 3 is fine. But that's really a big part of the calculation is to go back in history and calculate utilization rates to determine basically what's more likely than not to be paid. So we're still talking about leave that has not been used. leave that is more likely than not to be settled through conversion to defined benefit post-employment benefits should not be recognized as liability for compensated absences. So that's a part of your calculation of what's more likely than not to be paid. So in many organizations that we audit, the employees have the option to convert some of their earned vacation and sick leave into service credits. So we, for example, have a client that they can convert their unused sick leave to CalPERS service credits. We actually have another client that have a certain type of vacations that can only be utilized to be converted to a service credit or to be used in extreme situations, but is not a vacation that you can cash out. So the idea here is to look at the prior history to determine what is the average conversion to CalPERS service credits over the years. If you look and say, well, on average, people converted 5% of their sick leave to CalPERS service credits, well, because the defined benefit plans are accounted for under different GASBs, GASB 68 and GASB 75. So when an employee converts some of their sick leave to CalPERS service credits, those hours that were converted are no longer part of your compensated absences because they really become more of a pension liability and they are calculated under GASB 68. So all you have to do is just exclude those hours from the compensated absences calculation. So in order to exclude those hours, you have to estimate how much those hours will be. And the way for you to estimate it is by looking at history to see, well, what is the average conversion rate of sick hours to CalPERS service credits. If on average people convert about 5% of their sick hours to CalPERS service credits, then really you should only have 95% of your hours in your compensated absences liability and exclude that 5%. Okay? For compensated absences that are dependent upon the occurrence of a sporadic event that affects a relatively small proportion of employees, you should not recognize a liability until the leave commences. Examples are parental leave, military leave, and jury duty. It's hard to account for those. There should not be a liability on your books for any of these leave until the employee actually exercised the leave. Before somebody have a kid and go out on parental leave, you can't account for that. There is no liability until actually the person go on leave. And when the person go on leave, really the only liability that you will have is because you're continuing to pay their salaries when they're on leave. So the only liability you will have is if you haven't paid the salaries yet. That would be like almost like a payroll liability. But they should not be part of your compensated absences accrual unless they started using that leave. For the following type of compensated absences, a government should not recognize a liability until the leave is used. The leave that employee are able to take as needed without specific limits. That basically what we refer to as unlimited leave. Anytime somebody have unlimited leave, we can always tell that they work so hard and they never take any leave. That's why they tell them, it's unlimited, take whatever you want. But usually they're not able to take anything. They're always really busy. But because it's unlimited, it also doesn't accrue. And it's just there is no liability to record. Normally, unlimited leave when you terminate, there is nothing to get paid. So that's why you only account for it when it's being used. And then the holiday leave that is taken on a specific date, not at the discretion of employees. So these are the regular holidays, basically. They are part of compensated absences, but you're not supposed to accrue them until they are being utilized. So when it's basically New Year's Day and you have that as a holiday and you haven't paid the payroll yet, then this holiday will be part of your liability. But it has been utilized. People have taken that day off. All right. All right. And we're still talking about leave that has not been used. Liability should be measured using pay rates as of the date of the financial statements, except some or all the leave is more likely than not to be paid at a different rate. And leave that the leave is not attributable to a specific employee. If you have a shared employee leave pool, then you come up with an average rate. And some or all of the leave is more likely than not to be settled through non-cash means other than conversion to defined benefit post-employment plan. You should measure the liability based on the estimated settlement amount. And then changes to the measurement of the liability in future period due to a change in pay rate should be recognized in the period of change. So I just want to talk also regarding that first one, some of the leave is more likely than not to be paid at a different rate. I want to say that's probably not very common. Most of the clients we have, the rate is paid based on the most recent or the most current rate. But this is where FIFO and LIFO may become relevant and important. If you notice, GASB in the actual standard itself did not really discuss FIFO and LIFO. And did not say anything about, oh, you have to use FIFO or you have to use LIFO. If you read through the basis for conclusion for GASB 101, you will see that there were discussions about whether they should be specifying whether FIFO or LIFO should be used. And GASB said that they will not, that they will let you decide what you're going to use. Why is FIFO or LIFO would be even relevant here? Well, they're relevant in a few things. Well, first, they're relevant to determine what is your current portion of compensated absences, your current liability. Because if you are LIFO, like last in, first out, that basically means that you expect that whatever leave you're going to be paying in the next period will be paid out of leave that will be earned next period, or at least most of it, because that would be the last in, is what they earn in the new year, and that's the first they're going to utilize. So whether that will cover 100% of what they're going to utilize, maybe they will only cover a portion. So it becomes relevant when you're trying to calculate how much is my current portion on the financial statements. You may say, well, my current portion, I expect 60% of it will really come from leave that will be earned next year. And then 40% will come from existing leave. So this is when LIFO will become relevant, is to make that determination of what is my current portion. If you are using FIFO, then obviously your current portion, 100% of it will come from leave that has already been earned. So that's one importance of what they call the flow assumption, which you really should have, is what is the flow assumption? When people utilize their leave, what exactly are they utilizing? The leave that they just earned, or the first leave that they earned and still didn't utilize? And then, of course, FIFO and LIFO will become even more important if you use different pay rates to pay the leave. Then it becomes really important, because if the rate on the old leave is different than the rate on the new leave, then it's important to know which leave is being utilized when people take time off. Excuse me. All right, so these are just some of the discussions about the leave that has not been used yet, is really determining what's more, the leave that is more likely than not to be paid at a different rate. And LIFO and FIFO becomes relevant in this situation. Also, if you have a pool of vacation and sick leave, then you want an average rate. And then also, if you have anything that you expect to be settled outside of cash or non-cash. Yes, sir.
You're asking to calculate a liability for non-cash conversion to defined benefit plan, right? But in the previous slide, you said to not book a liability if it is converted to the benefit plan.
Well, okay, so the question is about the third bullet points and whether you should be calculating a liability for it or not. So the third bullet point is reading some or all of the leave is more likely than not to be settled through non-cash means other than conversion to defined benefit. So only the conversion to defined benefit is not part of your compensated absences. So if you're converting it to something other than defined benefit, it is part of your compensated absences. So the only thing that is excluded if you're converting to defined benefit plans. So defined benefit plans would be like your CalPERS plan. If you're converting your vacation and sick leave to a defined benefit plan, that is not part of compensated absences. This is here saying to be settled in means other than conversion to defined benefit plan. No, that's all right. Yes, sir.
So, okay, when we did our financial statements on the report, we would have, compensated balances. We would have the balance beginning of the fiscal year, additions of the people that accrued vacation, sick leave, whatever it is, and then subtractions and deletions, and then with a balance as of the end of the fiscal year. And then we would separate that balance as to the current portion of it, and then the long-term portion of it, and the current portion of it. Okay. So with this pronouncement, does that mean we have to go back to the beginning balances and apply the new standard to those beginning balances in order to compare apples to apples?
Yes. So the question is whether we have to go back and restate the beginning balance to reflect those changes. And the answer is yes. That it is basically applied retroactively. In the past, you used to take all the hours, 100% of the hours earned. And the difference here is that you may not take 100% of the hours earned. If you're more likely than not, calculation shows that you're not going to end up paying for 100% of the hours, then that's the situation. You're not going to account for that. So you should be adjusting the opening balance for those facts as well. All right. Now we're going to move to leave that has been used, and that's an easier one. A liability should be reported when leave is used for time off but has not yet been paid in cash, settled, or through non-cash means, including unlimited leave and holiday leave. And when you think about it, the only time this would happen is when somebody takes vacation or sick leave and you haven't paid them yet because the payroll was not due yet. So that's a liability. But this liability is already in the payroll liability if you're doing payroll accrual. So you don't need to record it twice. That liability, including all applicable salary-related payments, should be measured at the amount of cash payment or non-cash settlement made to be made for the use of the leave. And then let's talk about salary-related payments. So salary-related payments are obligations that a government incur related to providing leave in exchange for services rendered. And the term salary and salary-related payments represent any pay provided to the employee, whether it's a fixed amount or an hourly wage. Basically, that will include overtime, will include basically everything that those related payments are calculated based on. Examples of salary-related payment would include, employer share of Social Security and Medicare taxes. Liability for compensated absences should include the salary-related payments that are directly and incrementally associated with the leave. So those two were directly and incrementally. A payment is directly associated if the amount of payment is a function of salary to be paid. That is, the amount of the payment depends on the amount of salary. So taxes, for example, or Medicare, it's a percentage of the salary. So it is directly related to the salary. The more the salary goes up, the more that amount goes up. A payment is incrementally associated if the government will make a payment in addition to the payment for the salary. So it cannot be part of the salary. It has to be in addition to the salary. So you have the salary, and then you have the Medicare tax, then you have the FICA, then you have these things on top. So it has to be in addition to the salary, not part of the salary. So those are what we refer to as related payment. It has to be direct and incremental to to the salaries. A salary-related payment may be incrementally associated only with a portion of the recognized leave. So for example, you may be making 457 contributions, but only to active employees, meaning that when someone take time off or when they call in sick and they're still actively employed, when you pay them, you will still make 457 contributions to them. But if this person is retiring or being terminated, and you're going to pay them their outstanding vacation and sick leave, your policy may be that when you're cashing out, we don't make 457 contributions. But when you are active and you're utilizing vacation and sick leave, we continue to make 457 contributions. That means that you have to estimate how much we think they're going to utilize versus cash out. And then the portion that they're going to utilize, you want to add to it the 457 contributions. The portion that you think they're going to cash out, you don't want to add 457 contributions to that portion. So that's why it's important to distinguish between the two. All right. For leave that has not been used, expenses for salary-related payments related to defined contribution pension or OPEB should be recognized when the liability is recognized and should be reported as a pension or OPEB expense. Those amounts should not be reported as pension liability or OPEB liability. So we're talking about defined contribution plans. So those would be like the 457 plan, the 401A plan, not your CalPERS. Your CalPERS is defined benefit plans. So when you're making those salary-related payments, the 457 contributions and all of that, how are you going to expense them? So they're saying you should expense them as pension and OPEB expense. You should not expense them as salaries expense. They're not salaries. But you would expense them as pension and OPEB expense. But there will be no liability associated with them because these are, again, contribution plans. So you're only expensing what you're contributing. There is no pension liability or OPEB liability related to those. And then for leave that has been used, salary-related payments related to defined contribution pension and OPEB plan should not be included in pension liability or an OPEB liability. So notice the difference between the two. Actually, there is no difference between the two. I'm sorry? One has not been used and one has been used. Yeah, but it's the same accounting basically. All right. So basically what we're saying here is that when you're making those contributions to the 457 plan, if that is for benefit that has not been used, then you're adding that to your liability. If it's for benefit that has been used, it will only be added if you haven't made the payments. And then salary-related payments related to defined benefits, pension or OPEB, should not be included in the measurement of liabilities for compensated absences, even if they are directly and incrementally associated with the leave. So here, when we talk about defined benefit pension, we're talking about your CalPERS plan. And because defined benefit plans are covered under GASB 68, so no payment relating to those plans should be part of your compensated absences, nothing at all. So when you make those payments related to those, they should not be included in the measurement of your liability because those are covered under GASB 68. So they will be captured by the actuary and they will go through the calculation of pension liability under GASB 68. Notes to the financial statements has been simplified. So you don't have to show increases and decreases anymore. You can just show the change as a net change. Include a prior period adjustment footnote in the year of implementation. So that's what we were talking about, is because prior year may be based on 100% of the hours. The current year may be not based on 100% of the hours. So we would need to restate the prior year to reflect that. You obviously want to update the significant policies footnote. and no longer required to say which fund typically liquidate the liability. In the past, we used to be required to say that the liability used to be paid from the general fund, or this fund is responsible for paying the liability. Now we don't really have to say that. I want to just show you just a few examples to kind of hopefully show you in practice how it's going to look like. So this is just the note disclosure, and this is just part of your long-term debt note. So you can see here you have a line item for compensated absences, and in this case it's just showing the net change. So no additions and deletions, which quite frankly most of our clients didn't have the information. They used to plug the number anyways, so it's just easy now. You don't have to hide it. You can just say, yeah, this is the plug number for the change. And then again, here the case was a reduction, but again, the net change. So that's how it will look like in the notes. That's assuming you have it in your long-term debt note. You may have a separate note for compensated absences, so it will just be the same format, just in a separate schedule. All right, and then I wanted to kind of walk you through a worksheet that a client of ours, a former client of ours, actually prepared. And I just wanted to walk you through it just to show you what you actually have to calculate. I like this worksheet because it was simple. It was very customized to that client, so I kind of cleaned it up to make it more general. But this is just to show you what are the steps that you have to go through to come up with your compensated absences. So this part of the worksheet, this is the main worksheet. And then I'm going to show you the different tabs that goes after it. But this is an important part, because this client basically decided that, and remember, I removed all the numbers, so hopefully when it say NA, you just have to do the data entry. So this client decided that the best way is actually to come up with an effective hourly rate that includes all the related payments. So they basically took, and this is a client that have only 47 employees, by the way. So they did it on an employee by employee basis. So they went on the first employee and said, well, their hourly rate is such. We also pay longevity plan. We pay we pay special assessment, we pay uniform, we pay 457, we pay Medicare. This is our effective hourly rate. So now you included all the related payments into that one effective hourly rate. So the next step is really to just estimate, well, how many hours do we have times that effective hourly rate, and that's it, you're done. So this was just to show you how they came up with the effective hourly rate. Then you have those vacation hours and sick hours, and these are the ones that you have to estimate in order to come up with the dollar amounts, which will be the vacation hours times the effective rate, and that gives you the liability at the end. So how do they estimate the vacation hours and the sick hours? So if you look here, that's how they estimated them. They basically have history information, the last 5 years. I don't recommend 5 years. 3 is fine. But they had history information of accrued, taken to come up with percentage of usage. And a worksheet after that, they basically applied that percentage of usage to their total hours that was earned, their vacation and sick leave. They also applied the vacation cap. So if somebody have 200 hours of vacation, the vacation cap is 150 hours, then obviously they're going to be calculating the liability based on 150 hours, not the 200 hours. The sick leave, for example, in a client like this, they only pay, they don't pay for upon termination, so they needed to know, well, how much of sick leave we think they're going to utilize. So they did that by basically doing this, by looking at, oops, went a little too fast here. By looking at the history to see, what were their utilization rates over the last 5 years, come up with a percentage which really average those usage in the last 5 years, and then apply that to the sick leave balance that they have for each employee. So if the utilization rate is 80% and you have an employee that have 100 hours of sick leave, then you're really only picking up 80 hours. Assuming that those 20 hours that they're gonna cash out, that are not being picked up, that's under the assumption that no cashing out at termination. If you are allowed to cash out 50% at termination, then you will take those 100 hours total, you say 80% utilization, so we need to have 100% of those 80 hours. And then 20 hours that they're going to be cashed out, we need 50% of them because employee is able to cash out 50%. Then you end up having 90% of the hours, 80%, which is 100% of the ones that will be utilized, plus 50% of the ones that will be cashed. That adds up to 90% of the total. So this is, in my opinion, is a simple worksheet that just takes you through the process that, of the things that you have to estimate. That the first thing you have to estimate is what is our, or actually calculate is what is our pay rate. You can choose to have your regular pay rate and then you add the related payments later. So you can take the rate times the hours, come up with the liability and say, okay, plus these related payments. Or you can come up with the related payments first and apply them to the pay rate. And that way you have like a fully loaded rate that have all the related payments. So that's the first step, is to figure out those related payments. Actually, you don't really have to do them in order. You have to calculate the related payments. You also have to estimate the hours. One can be done before the other. It doesn't really matter. Yes, sir. And then basically, this is how you calculate the hours that you expect that you will have to pay by really just looking at history. And when you look at history, you also have to use your judgment. So in this case, for example, it's a small city. So they're doing it for every employee. On larger cities, you don't have to do it for every employee. You can, and actually the GFOA tool that they have on their website is not using on an employee by employee basis. But what they're doing is that they're actually sampling every bargaining unit. So you can say, well, I'm going to take 10 people from police, and I'm going to take 10 people from fire, and I'm going to take 10 people from public works, and I'm going to take 10, or whatever your bargaining units are. I mean, public works and and finance may be in the same bargaining unit, but however you want to slice it. But the idea is that if you're a big city, you don't really have to go employee by employee, but you have to pick a sample from each bargaining unit that you think would be representative of this bargaining unit. And all right, so that's working. So for example, if you're looking at a bargaining unit and you're trying to calculate what is the history, you may pick a sample, but then if you have the fire chief, for example, in the sample, and the fire chief is the most highly paid person in that group, and also never take time off, you may want to exclude that person from the sample because it's just going to make the numbers not representative of the population. You may want to take that person and do them separately. And just so making sure that your sample is representative of the population is also important to ensure that you're coming up with a good estimate. So I want to make sure I didn't miss the question. I did? Okay, I'm glad. All right.
Extra payments may differ if an employee is retiring or terminating their employment versus employee is using the hours. So can we use like prior year, like 3-year data trend and to estimate, okay, 20% are just the cash out payment with no other benefits and 80% are going to be with other payments, whatever the other payments are. Can we do that?
Yeah.
Estimation, and as long as we stay consistent.
I think that's the hope. The question is whether that basically related payments may differ or may be different, whether the employee is active employee or somebody who's being terminated. The 457 contribution would be a good example where a lot of organizations may not make those contributions to terminated employees. So that's the idea of estimating how much of the hours you think will be utilized versus cashed out, because the ones that will be utilized, those are the ones you want to apply all the related payments on. The one that will be cashed out, you may select certain related payments to be applied to them, but not all of them. So that is correct, yes. Yes.
On that spreadsheet, is that balance and total accrued? I'm not sure. Is it the balance for the end of the fiscal year? There are three questions I have. And then the other one is sick time accrued. Is that the accrued for the fiscal year? For 1 year only?
You mean this column?
Not the further to the left. What's the difference between balance and total sick time accrued? Is that for the year or for that's because this GFOA has kind of a that thing too, and it was not explained in the tool. So I just wonder how to come up with that.
So this is not the GFOA one, and I did look briefly at the GFOA one. So basically, those are beginning balances. So prior to those changes, to those years of history. And the main purpose of this worksheet is really just come up with the percentage of usage. That's the main purpose of the worksheet. But the actual liability and the hours are really, are really in this worksheet, which is the first one. And this, I keep hitting the wrong button, sorry. In this worksheet. And these will be the vacation hours and the sick hours that will be part of your liability. And those are the ones that basically are estimated to be what's expected to be utilized or cashed. And how is derived from using that percentage of usage and multiplying that by what's actually in your books as far as cumulative vacation and sick leave for each person. So those numbers here should be from your records, how many hours each person have accrued for whether it's for vacation or for sick. And then you apply to them the utilization percentage. And that takes you to here. One more. Where these hours are reflected here. So, so again, it's you start what's in your books, you apply to that utilization percentage, it gives you the hours that should be in your liability. Well, when you say so this worksheet is based on all active employees as of the fiscal year. So some of them may not necessarily have history if they're brand new employees. And I think this is where you're going to have to either develop, like use maybe similar employee with similar age or similar to basically come up with that, or to use the average. Like if you average all of those, and maybe for new employees, you apply the average instead of the actual. Remember, this is done on an employee by employee basis, but most work calculations are not going to be employee by employee basis. Like the GFOA one is not an employee by employee basis. So the idea is to come up with an average, and then you will apply that to new employees who don't have history and so on. Okay. All right. I'm going to try to move a little bit faster so we stay on time. Um, but again, I'm not saying this is the only tool out there. I just wanted to show you how a tool would work, just to basically kind of give you an idea about what really needs to be calculated. I know that the GFWA have its own tool. I just heard this morning they actually have two tools, and it seems like both of them are kind of complicated. I'm sure there are many other tools out there. But this is really not to promote this tool. This is not our tool, by the way. I just wanted to put this as a simple worksheet to kind of just explain to you what you're expected to calculate. You can develop your own, but really the bottom line is you you need to have a way to calculate what the related payments are, and you need to have a way to calculate what the expected hours to be paid are. And usually that's based on looking at the history and coming up with utilization rates. Yes, Tim. Yes, I can. All right. Okay, I think that's all I wanted to say about GASB 101. So we can move on to GASB 102. And GASB 102 is an easy one. It is a disclosure statement. Anytime you have a disclosure statement, means you don't really have to change any of your accounting. You don't have to do anything on your GL. It's just a financial statement disclosure. And this is regarding certain risk exposures. So the purpose is that governments may be vulnerable to a variety of risks. And existing guidance requires government to disclose their exposure to some risks, but not all. And other prevalent risks among government is not routinely disclosed because it's not explicitly required. GASB 102 provide information about risk related to government vulnerability due to certain concentrations or constraints. So those are the two things we're focusing on, concentrations and constraints. So a government may be vulnerable to risk from certain concentration or constraints that limit its ability to acquire resources or control spending. A concentration is a lack of diversity related to an aspect of significant inflow of resources or outflow. A concentration is a limitation that is imposed by an external party or by a formal action of government. And I guess I was going to give examples, but the slides have examples. Concentration can be employers. For example, you have one major employer in your city. So this employer going out of business can be very detrimental to your city. Industries, if you have specific industries, and this industry is being like tourism, for example. Inflow of resources, like concentration in your revenues, in your workforce, where all of your employees are part of one bargaining unit. Providers of financial resources, we have a client that they are 100% grant funded. So, and like 90% of their funds is from one grant. So they're definitely have concentrations there. And then suppliers of materials, labor, or services. If you're relying on one supplier, that can be concentration there as well. Then you have constraints. And this can be limitation on raising revenues, limitations on spending, limitations on incurrence of debt, or mandated spending. I can give you some real life examples on both of them. So we have a city that have a really big retailer. Can't remember if it was Home Depot or Best Buy that pays almost half of their sales tax. So that's a concentration. We also have a city in Southern California who the citizens have basically lobbied for a measure and it passed. And that measure requires the city to spend up to 10%, I think, I want to say 10 or something percent of the general fund revenue for a specified purpose. So that's a constraint, that's a mandated spending, and is actually putting a lot of financial pressure on the city. So that's probably going to be a disclosure for that city. But these are just examples of what the concentrations are, what the constraints are. However, having a concentration or a constraint by itself does not trigger a disclosure. So there needs to be factors that are met in order for the disclosure to be required. So the disclosure is applicable to the primary government, including its blended component units. All other reporting units that report a liability for revenue debt, and disclosure is required if all of the criteria below are met. So remember here that it is mostly for the primary government. So if you're a city, it's mostly for your city. But also if you have other reporting units that have a liability from revenue debt. So for the revenue debt would be like a water revenue bond or a sewer revenue bond. And you have, and it's a reporting unit, meaning that it's basically a major fund when we say reporting unit, normally we refer to them in our audit opinion. We say we have audited the governmental activities, the business type activities, each major fund, and the aggregate remaining fund. So if it's one of those and it have those liability from revenue debt, there would be disclosures on that if basically that activity have the concentration or the constraint. But in order to have the disclosure, you are supposed to meet all the criteria below. Concentration or constraint is known to the government prior to the issuance of the financial statement. So it's not something that you didn't know about. You had to have knowledge before you issue the financial statements. The concentration or constraint makes the reporting unit vulnerable to the risk of substantial impact. So for example, this client we have that have Home Depot, that's half of their sales tax. That's very impactful if they don't have that. Also, an event or events associated with the concentration or constraint that could cause a substantial impact have occurred, have begun to occur, or are more likely than not to occur within 12 months. So in the case of my client and Home Depot, there was an event that occurred. The state of California came and said, you're not entitled to those sales tax. We made a mistake. We have been paying you those sales tax, but just because the warehouse is in your city, but in reality, really, the sales tax should go to all the cities where the people who bought the products reside. So for a city like this, they stand to lose half their sales tax. So for them, that's a big concentration. And there is an event that basically indicate that this may be gone. So substantial impact is very likely. Another situation can be if you heard that Home Depot is thinking about moving, that they are not renewing their lease. That's an event that will trigger that. In the case of the spending constraint, spending mandate, city of Pomona in Southern California, the residents sponsored a legislation that mandated the city to spend, I want to say 10% of the general fund annual revenues on some school and some children and family programs. So there is an event that occurred, that revenue measure passed. And that's now causing a lot of impact on the city. So I think that's going to require disclosure. So these criteria has to be met. So the fact that you just have a constraint by itself is not enough to disclose that information. There needs to be those criteria, those three criteria, in order for you to have that disclosure. Yes, sir.
Give the event non-measurable. Is measurability part of the disclosure?
I don't know if I don't think so. I don't believe.
State of the federal government and canceling out all kinds of funding for state, local, grants, which they have threatened to do, it's not measurable on what your limits are, but for the clear fact of those programs such as Office of Emergency Services, FEMA grants that a lot of agencies rely on, that whole thing is hanging over the head of all these government agencies. So would that be a disclosable event?
Well, I mean, I think professional. So the question is whether an event has to be measurable in order to be considered. I would say no, and also I would say that this is a disclosure statement. It's not really asking you to measure anything or to adjust any numbers. It's just asking you to disclose that you are exposed to those risks. I would say that it's hard to measure those, and it actually says that an event either has occurred, have begun to occur, or probable to occur in the next 12 months. So it doesn't mean that it has occurred, but it just has a high probability of occurring. So definitely, we have a client that I want to say 90% of the revenue is coming from Head Start program, which is a federal program. If there are talks that this program will be suspended, of course, that is something that they would have to disclose. It's not really measurable at that point, but there are talks about a lot of the block grants being significantly reduced. I think it's going to be on a client-by-client basis. They first have to determine also that the constraint makes the reporting unit vulnerable to the risk of substantial impact. So if it's not substantial impact, there is nothing to disclose. It has to be that it's substantial impact, it's likely to occur or has occurred already. I don't think that you have to be able to measure it. All right, and then also I want to say that if mitigating actions taken prior to the issuance of the financial statement cause any of the disclosure criteria not to be met, then you don't need to disclose anything. So if the management have already taken action, and that makes it that, okay, one of the criteria no longer apply, then you no longer have to disclose that. So what do you have to disclose then? If comparative financial statements are presented, you really are focusing only on the current year. This information is not very relevant to the prior year. We're really just looking at the current year. Certain disclosures required may supplement no disclosures required by other guidance. So we try not to duplicate information that is the same for more than one reporting unit should also be combined and avoid duplications. And then disclosure relating to discretely presented component unit is subject to the requirement of paragraph 63 of statement 14. And then basically this is the required disclosure to provide information in sufficient detail to enable users to understand the nature of the circumstances disclosed and the government's vulnerability to the risk of substantial impact. It should include the concentration itself or the constraint, each event associated with the concentration or constraint that could cause a substantial impact, if the event had occurred or had begun to occur, and also action taken by the government prior to the issuance of the financial statements to mitigate the risk. So those are the disclosures that are required. Again, for a lot of you, this statement is not going to apply. You may not have those concentrations, and if you do have them, you may not meet all three criteria to actually have that disclosure. But for those of you who have these concentrations, it will apply. All right. So now we're going to go to the standards that are due next year. So those two, GASB 101 and 102, are due in fiscal year 25. Most of you will deal with GASB 101. A lot of you may not deal with GASB 102. The next standard here are GASB 103, and this is due next year. I'm just going to double check the chat here. Nope, no questions. So GASB 103 is mostly a financial statement standard. So it should not impact your general ledger. It should not impact the accounting that you're doing on a day-to-day basis. It may impact the groupings of your accounts in the financial statements, but otherwise it's really just a financial statement standard improving the existing financial reporting model. So the scope of GASB 103 is to establish new requirements or modify existing ones for the following. MD&A, so that's a big focus of 103 is the MD&A. Unusual or infrequent items. So that's a new definition or a new term, replacing special and is it extraordinary items? Yeah, special and extraordinary items. Presentations of the proprietary fund statement of revenues, expenses, and changes in fund net position. So your income statement of the proprietary funds, your enterprise and internal service funds, will look different. We have new categories. We have new definitions of operating and non-operating revenues. Information about major component units in the basic financial statements. Also, budgetary comparison information is going to change in the financial statements. And then finally, financial trends information in the statistical section. So let's start with the MD&A. The basic principles of the MD&A, and in my opinion, most of what's in this statement is really not much different from what GASB 34 required. It's just that not everyone followed the guidelines of GASB 34. So I feel that this is just really re-emphasizing a lot of the things that were required in GASB 34 with minor changes, but it's not, fairly new. It's not all new stuff. Provide easily readable analysis based on currently known facts, decisions, or conditions as of issuance date. So just by reading that sentence, I would say easy and readable format. That means that the MD&A should really be no more than 10 to 15 pages. You should not have a 30-page MD&A. I can guarantee you that half of it is probably information not required and not supposed to be there. So you should really just stick to what's required. No additional information, no duplication, just stick to what's required. Written in a manner that can be understood by users with no detailed knowledge of government accounting. So remember, the reason why we have an MD&A is because people don't want to read the financial statements. So don't make the MD&A look exactly like the financial statements because it defeats the whole purpose. People are not going to read it. So it's supposed to be designed for people who don't know a lot about accounting to be able to read it and understand what happened during the year. Focus on current year compared to with the prior year with emphasis on current year. Avoid duplication. And then focus on the primary government and distinguish between the primary government and discretely presented component units. Just remember that the primary government is the main statement in your financial statements. I know you may not care about it that much, but the government-wide is the main statement, and that's the one that you're going to be focusing on in the MD&A. But also within that, the primary government is who we're reporting on. The primary government is your city or your special district. That's what you should be focusing on. And the discretely presented component units. The blended component units, like the Public Financing Authority and those types of component units, don't need to be discussed in detail in the MD&A. The primary government and the discretely presented component units. All right. So the information presented in the MD&A should be confined to the topics discussed in the 5 sections outlined below. That means no other topics. You have to stick with those 5 topics. Overview of the financial statements, financial summary, detailed analysis, significant capital assets and long-term debt activity, and then currently known facts, decisions, and conditions. I'm going to talk about each one of them. So overview of the financial statements. Oh, am I going through the same slide again? Looks like it. Okay. All right. So overview of the financial statements. It is exactly how it sounds. It's an overview of the financial statements. It's a description of what the reader is about to read. That we have a government-wide, that we have fund financials, what the government-wide uses as far as the basis of accounting, the fund financials, the relation between the two, all of that. So the relationship of the statements to each other. Focus on significant difference in the information the financial statement provides. So focusing on the difference between what a government-wide would provide versus fund financials. And then financial summary. Financial summary is supposed to be condensed information derived from the government-wide compare current year to prior year for both governmental and business type, provide information needed to support the analysis of financial information, position and results of operation. So financial summary elements to include total assets, which are capital assets and other assets. So basically, this is kind of the level of detail, the minimum level of detail that you need to use. And it's actually really very high level. Like it's you capital assets and other assets. And then you have the deferred outflow of resources, total liabilities, which would be broken into long-term and other liabilities, total deferred inflow, net position, and the categories of net position. So that's how you want to compare the prior year to the current year by having a minimum this level of detail. Okay? Right? And then also on the income statement or on the statement of activities, you can have program revenues, which will have the charges for services, operating grants, and capital grants. Then you would have general revenues by major source, then total revenues, program expenses by function, total expenses, excess deficiencies, contributions to permanent endowment, transfers, unusual or infrequent items, and then beginning and ending, and the change in net position and then ending. So these are the line items or the categories in your comparative statements in the comparative part of the MD&A. This is what you expect to have, those line items. You cannot summarize more than that. So this is the minimum requirement that you have to have those categories. And these are usually just the tables. So normally those are presented in the table format in the MD&A. Detailed analysis, that's a really important part for the government-wide and for the fund financials. For the government-wide, significant changes to governmental and business type activities. Explain why changes occurred and their magnitude, the why, not just the what. So this is extremely important, and I have to say that for a lot of our clients, we don't really see the why, we see the what more than the why. It's supposed to be the opposite. So providing information in the MD&A saying, well, our net position increased by this much because our revenues went up by this much and the expenses went down by this much is not really very useful information. First, anyone who's reading the financials can see that. Second, after reading that, they are as knowledgeable about your organization as before they read this information. They don't really know anything of what was the reason revenues went up, what was the reason expenses went down. All they know is that they did go up and go down, and that's not very useful. So that's the idea here, is that providing the why, not just the what. So that's really, really important. Include facts, decisions, or conditions that the users may not be aware of, and then discuss policy changes and economic factors that significantly affected operating results. Changes in rates, changes in what you bill and don't bill, passing new revenues, adding transfer tax, those types of things that basically explain what happened. The same with the fund statements, significant changes to each major fund. So when it comes to fund statements, not just in the MD&A, but throughout the financial statements, it's always about major funds. We talk about major funds and non-major funds. Each of the major funds have to be discussed individually, not in totality. So when you're providing analysis of the fund financials, significant changes to each major fund, explain the why, not just the what, includes facts and decisions not known to the reader, discuss restrictions, commitments, assignments that significantly affect availability of fund resources. So for example, City of Pomona, I'm sorry that I know that they are with us somewhere here or online, or both. But I think they're going to need to discuss in their MD&A their part of fund balance that is now legally restricted for that new spending mandate. 10% of the general fund revenue has to be spent in a specified manner. So any amount that is left that hasn't been spent yet will be restricted. So this would be a very good discussion in the MD&A to talk about those restrictions. And then should focus on explanation that differ from the analysis of the government war. You don't want to just copy and paste the same analysis that you gave for the government-wide to the fund financials. The idea is not to duplicate. If the analysis that you gave for the government for the for the government-wide is going to be exactly the same as the fund financials, then maybe you just say that and refer the reader to the government-wide analysis. But don't just repeat it. But maybe just focus on what's different in the fund financials than the analysis that you gave to the government-wide. All right, significant change, capital assets and long-term debt financing activities. So for capital assets, talk about significant capital assets activity during the year, including certain intangible assets, significant additions and disposals, significant policy changes and economic factors, and should not duplicate analysis provided anywhere else. And same was the long-term debt. Significant long-term debt financing during the year, agreements entered into, changes in credit ratings, changes in debt limitations, significant policy changes, and you also should not duplicate analysis done in other places. And then finally, currently known facts, decisions, or conditions. So descriptions of currently known facts and decisions that are expected to have a significant effect on the financial position, or that are expected to produce significant differences from current period results of operation. So remember, every discussion you have in the MD&A is designed to really tell the reader, why is this year different from last year? That's what the focus of most of your analysis is. Why is this year different from last year? What happened this year that is different from last year that caused these changes to occur? So examples of currently known facts and decisions. Trends in relevant economic and demographic data, such as changes in population, customer base, income levels, building permits, enrollment, unemployment rates. So all of these are good discussions. Relevant factors used to develop the subsequent year budget that will provide an indication of how results of operations are expected to change in the subsequent year. Changes in tax rates or fee amounts or changes in economic base. Expected changes in budgetary net position, actions the government has taken related to post-employment benefit liabilities, capital asset improvement plans, lease liabilities in subsequent periods, and also actions other parties have taken that will affect the government in subsequent periods, such as new legislations or regulations imposed by other governments. So again, we don't want this part to be, you can just put anything you want and say, well, it's all relevant facts. Again, keeping in mind that those facts have to be relevant to the changes that occurred during the year or that may impact the results for next year. So again, professional judgment will be used, but it really needs to, it's not a place where you can just put everything you know or everything you want to say about what's happening in your organization. It really has to be in the right context. All right, so I actually only have 15 minutes left. So I'm going to try to move a little bit faster. Unusual or infrequent items. So those are not totally new. It's just a new definition, new terms. We used to call them special and extraordinary items. So now they're called unusual and infrequent items. Are transactions and other events that are unusual in nature or infrequent in occurrence. And unusual nature means possess a high degree of abnormality and be of a type clearly unrelated to or only incidentally related to the ordinary activities of the government, taking into account the environment in which it operates. So it really has to be something that is unusual to your operation. It cannot be something that can happen on a regular basis in your operation. And then it has to be infrequent in occurrence, would not reasonably be expected to recur in the foreseeable future, taking into account the environment in which the governments operate. So an example, for example, would be flooding. Flooding can be an unusual and infrequent occurrence, but not if you're a flood control agency. where that's why you exist. You're expected to have flooding and to be working to prevent that. So that's what they mean by unusual in nature. Flooding for a flood control agency is not unusual in nature, but it may be unusual for a city or a water district, or something that is really not related to your operation. Okay, and it has to be infrequent in occurrence. And remember that COVID-19 was not considered by GASB to be unusual in nature or infrequent in occurrence. So just understand that the bar is high, that the pandemic was not considered, did not meet those criteria, because they said, well, we had pandemics before. We expect to have more pandemics in the future. It was not something that is unusual. So just letting you know, that's not every time something happened that is different than your daily routine does not automatically qualify as unusual and infrequent. The bar is high for those. Should present as the last presented flow of resources prior to the net change in resource flows. So basically all the way at the bottom of your income statement, that would be the last category, would be the unusual and infrequent items. Inflows and outflows related to each unusual and infrequent item should be presented separately and not netted. So if you have proceeds and then you have outlays, you cannot net the two. If you have a flooding, then you have an insurance recovery, you cannot net the two. Should disclose the program, function, or identifiable activity to which an unusual or infrequent item is related, if applicable, and whether that item is within the control of management. So this is how an unusual and infrequent item would look like. It would be all the way at the bottom after transfers, and all revenues would be right before the change in net position that you would have that. And you can see here that we broke it down into grant revenues and cleanup. So you're not supposed to net them together. Here in this case, you had to do cleanup work, but then you also had a grant to offset that, but they are shown separately. And then also on the governmental funds, it will be at the bottom here, the unusual and infrequent item. Okay. All right. Then you have to have a disclosure. So not obviously, if you have an item that is unusual and infrequent and you decided to put a separate line item for it, it's most likely material. So it does require a note disclosure. And this is just an example that show you what a note disclosure would look like for that unusual and infrequent item. And you can see that we're discussing basically the detail, 10 million, and just really providing the breakdown, the grants, the expenses, and all of that. Yes, sir.
Should you put down the caption with a zero? And the reason I'm asking this is why, because I'm thinking about if you don't have any and you send it to GFOA for their award, they may say you forgot to put in infrequent or unusual events, and they make a remark about that. So I'm just trying to say, well, we put down the classifications, but we put down zero, just to make sure that they understood we took that item into consideration.
The question is whether you should have those line items regardless of whether you have an amount there or not, to ensure that it's clear that you didn't miss the implementation. And my answer to that is no, you don't have to. I think it's pretty clear whether you have this item or don't have it. It's up to you. There's nothing wrong with having the line items with zero amounts in them, but I believe that you don't really have to. In general, all of our financial statements, we take out all the zero balance line items. We don't have line items with zeros. I think the fact that you had an unusual and infrequent item that was material will show somewhere that will, one of your expenses will be higher than, the prior years, one of the line items. So it will show somewhere, but again, I don't think that you have to have it if the numbers are zero. That's my opinion on it. All right. Um, Moving on to the presentation of the proprietary funds. So the proprietary funds income statement is seeing a bunch of changes. First, we have definitions of operating and non-operating items. So that's a new definition. We have new categories, non-capital subsidies. The unusual and infrequent items are also added. So some changes to the presentations there. So we distinguish between operating and non-operating revenues and expenses. Separately report non-capital subsidies. Present the following information in the order shown using all-inclusive format indicated. And I'm just gonna go through them like this. Start with operating revenues, then total operating revenues, operating expenses, total operating expenses. Then you have operating income, the difference between operating expenses and operating revenues. Then you will have the non-capital subsidies, and those would be transfers in, transfers out, and non-capital subsidy. Then you will have a total for that. Then you will have operating income or loss and non-capital subsidies, a total of all the items above. Then you will have other non-operating revenues and expenses. Then another total. Then you will have basically a summary of everything above. Then you will have the unusual and infrequent items. Then an increase in net position, your beginning net position, and then your ending net position. So how this is going to impact you in your accounting? Nothing. It's no change to the accounting. You will probably need to change some of the groupings on how the accounts roll into the financial statements. Things that you used to call non-operating now may need to fall under non-capital subsidies or may need to fall under operating. As you're going to see in the next slides, GASB did define 5 items that can be in non-operating. If your item is not one of those items, it cannot be in non-operating. Non-operating in the past used to be the bucket where you put everything that you either don't know where to put or doesn't sound like the other parts. So now you can no longer do that, which really pushes you to think about it more and say, well, okay, well, if it's not non-operating, then what is it? Is it operating, or is it unusual and infrequent item, or is it non-capital subsidy? Remember, non-capital subsidy is non-operating. So in any case, just that's a significant change for the enterprise funds. So operating revenues and expenses. I love this definition. Operating revenues and expenses are revenues and expenses other than non-operating revenues and expenses. It's a very informative definition. But they also went on to define what non-operating revenues and expenses are. So they're defining the non-operating revenues and expenses, and then they're saying operating revenues, anything that does not meet the non-operating revenues and expense definition. So what is non-operating revenues and expenses? They are these 5 items: subsidies received and provided, contributions to permanent and term endowment, revenues and expenses relating to financing, so interest income, interest expense, interest expense, resources from the disposal of capital assets and inventory, so, and then investment income and expenses. Then you have subsidies, and you can have either subsidies that you're receiving or that you're paying. For the ones that you're receiving, the proprietary fund does not provide goods and services. So it cannot be that you're providing a service and then you're getting money in return. That's not subsidy. So you have to be that you're getting the money without providing the service, and that this subsidy that you're getting is directly keeping your rates down. That if you don't have those subsidies, you will have to increase your rates. So that's what the definition is. And then if you're providing subsidies, it has to be that the other party is not providing you goods and service in exchange for those subsidies. and that the subsidy that you're giving, that you're recovering from your ratepayers, that you're actually, it's part of your rates, that you're getting the money back. And then all other transfers. So your operating transfers in and out will be under subsidy as well. All right. So revenues and expenses that are otherwise would be classified as non-operating in most proprietary funds should be classified as operating revenues or operating expenses if those transactions constitute the proprietary fund's principal ongoing operation. So obviously, it's basically saying like, you know, interest income for a bank is operating revenues versus interest income for everybody else is not operating revenue. But if this is your business, then that's operation. So the same thing here. Interest revenue should be reported as operating revenue by a proprietary fund established to provide loans to first-time homeowners, because that's basically the operation of that fund. So interest would be just operation in that situation. And this is how it would look like. You see we have the operating revenues, operating expenses, then the non-capital subsidies, then other non-operating items. In this case here, we don't have unusual and infrequent items, but that can possibly also be there. So those would be the new categories of the income statement. All right. I need to speed up. Actually, I'm already at time. So I told you I'm going to wipe out all those ahead of time during the day. But in any case, I'll try to be mindful and finish in the next few minutes. Also, a new requirement now is presenting the major component units. So currently, we can combine all the major component units into one column. But in this case, we're not going to be able to do that. So we have to present each major component unit separately in the statement of net position and activities if it does not reduce the readability of the statement. If it does reduce the readability of the statement, then we actually don't present it separately on the government-wide, but we do have to present a combining statement of component units. So this is how it would look like. In this situation, it doesn't impact the readability. So it's just really one column after the primary government. And that's, you know, doesn't cause any issues. Same with the income statement or the statement of activities. It would be at the end here, and it doesn't cause any issues. But what if you have 8 of them? Then it would impact the readability. So in that case, you will actually just have one column saying component units, and then you will have an additional statement called combining statement, and this will show all the component units broken down. So that will be after the fund financials. Right? I thought it was after. After the fund financial statements. So you will have the government-wide, then your fund financials, and after that you will have the combining major component units financials. All right. And yeah, so basically you will see that you will just have the breakdown in the combining statement, and then you will have one column. Actually, this one, yeah, one column, non-major component unit, and that's it. And then moving on to the RSI. So this can be a change for some of you. Any of you here is, or actually are including their budgetary comparison information not as RSI, but part of your, like right after your fund financials, have your budget comparison? Nobody? Okay, well, that's good, because you're no longer allowed to do that. But we did have a few clients who did that, where you would have your government-wide, then your fund financials, then you will have your budget to actual comparison. It used to be an option. It is no longer an option. So now the budget comparison are required to be in the required supplementary information. It cannot be in the body of the financials. separate columns for variances between original and final budget amounts. So that's new. We used to only compare actual amounts to final budget. So now we're going to have two comparison, original to final budget. So really budget to budget, original and final. And then final budget to actual amounts. So we have two comparison, not just one. Explanation of significant variation between original and final budget. Amounts and final budget amounts and actual results is required to be presented in the notes to the RSI. So this is how your budget to actual would look like. You will see here that we have two variances. We have original budget, final budget, then a variance column. Then we have actual amounts, then another variance column. Okay? And then you will also have to provide explanations of, maybe on the next slide, of basically what the variances came from or what's the cause of those variances. So you start here, you're talking about budgetary revenue, differences between final budget to actual, original budget to final budget, original budget to final budget. So you actually do have to have that, the explanations of what those changes are. So definitely more disclosure on the budget side. And it makes, I think it's great because honestly, some of the numbers we see between the original and final budget, it'd be like, you know, how did you go from here to there? That's just such a big difference. And then some of them are even more interested, where you see like original budget 100 million, then final budget 130 million. Then you look at the actual numbers and they're like 90 million. So why did you go, like you already had a good budget. Why did you adjust it to 130 and then you ended up having 90? So I'm sure there are explanations, but I think that's what this will be valuable, is that this explanation will make it more sense, make more sense to the reader. And then finally, in the statistical section of separately issued financial reports, governments engaged only in business type activities or only in business type and fiduciary activities should present revenues by major source for their business type activities, distinguishing between operating, non-capital subsidy, and other non-operating revenues and expenses. So basically, this is only if you are an enterprise activity. So if you're a city or if you're a county, that does not apply to you. But if you're a water district or a sewer district, you're using enterprise activities, this will apply to you. And basically means that, you know, your statistical section now needs to have those non-capital subsidies, operating and non-operating and all of that. All right, and that's statement 103. And I may only be like 10 minutes late, so that's not too bad. Any questions on 103? Okay, that's a question here, an interesting question. For 2-year adopted budgets, is the original considered the 2nd year amended budget? That's a good question. I have to think about that. I want to say I have to think about it. So
the unusual or infrequent items, is that similar to the the special items that from GASB 69? We were working on that. Would that be in conjunction with it, or would those be reported separately?
the special and extraordinary items no longer exist. So this is to replace special and extraordinary items. So now we're going to have unusual and infrequent items. There are no more special and extraordinary items. Okay. Yeah. All right. Okay, so we're almost done. 104 is actually easy. I know that you guys want to take a break, but I'm not going to let you until we finish that. But it's only 3-4 slides, so it should be done fairly quickly. So statement 104, on the surface, it looks super simple, and it is, with just one little thing that I think may cause just some of our clients to think about what they used to do in the past and whether that really still makes sense. So Statement 104 talks about separate disclosures for certain capital assets. And it basically says that the following capital assets and related amortizations should be disclosed separately in the capital asset note disclosures required by GASB 34. So keep in mind that it cannot be just disclosed separately. They're saying in the capital asset note required by GASB 34. What that means is that you need a beginning balance, additions, deletions, ending balance. You have to report them by asset class and accumulated amortization. So you cannot lump them together. It has to be like buildings, equipment, accumulated amortization for building, accumulated amortization for equipment. So that's what GASB 34 require. So this is not just saying, oh, just show them separately. They need to follow the GASB 34 format. Okay. So those are the assets that have to be disclosed separately. Leased assets, those are assets from GASB 87 by major underlying asset. Intangible right to use assets recognized by an operator in accordance with GASB 94. I know most of you did not have to deal with 94. And 94 is almost always very material. Like if you really have a 94 agreement, a public-private partnership, it is usually very material. So you either don't have it or you have a really material one. So if you're an operator, you have an intangible asset. So that also should be disclosed separately. And then this beta assets, GASB 96, the information technology arrangements, that too has to be disclosed separately. And then intangible assets other than those above. So any other intangible assets also have to be disclosed separately. Intangible assets that represent the right to use a type of underlying assets should not be disclosed in the same major class as any owned assets of that type. So if you own a building and you also lease a building, you cannot report both of them in the same category. You have your regular assets, you will have a building and an accumulated depreciation building. Then you will have leased assets, then you will have building, accumulated amortization for the building because it's a leased asset. They cannot be combined together just because they're buildings. They are separate, they have to be disclosed separately. All right. And then this is the one that I think is going to bring a lot of questions. A capital asset is a capital asset held for sale if the government has decided to pursue the sale of the asset and it is probable, likely to occur, that the sale will be finalized within 1 year of the financial statement date. So I'm just curious, by show of hands, how many of you have on their financial statements asset held for sale? Yeah. Just one? No way. I am sure there are more. If I review your financial statements, I'm sure I'm going to find some more. In the successor agency, you probably have some. In some of your housing funds and other funds, you may have some. But the bottom line is there is really no guidance that say that you can be recording something called asset held for sale or property held for sale. Really, the guidance is when you look at GASB 72, it says when you buy an asset, you have to make a decision. It's a one-time decision that you cannot change. Are you buying an investment or are you buying capital assets? There are only two of them. You're either buying an investment. If you're buying an office building and your plan is to not occupy it, you're going to rent it out and that's an investment. Or are you buying an office building to occupy? Those are the choices that you make when you purchase an asset. You cannot change those choices. You cannot say, well, now it's an investment. So because that requires remeasuring from a basically historical cost to fair value. And it's just going to be, well, the next year you say, well, I changed my mind. I'm not going to sell it. I'm going to use it. Then you remeasure again. So the idea with GASB 72 is that you don't do that. You just make one decision and that's it. This one is a little different. It's already a capital asset. So when you basically purchase it for the purpose of either selling it or that you decide to sell it, there is no requirement to remeasure anything. The only thing you have to do is you have to disclose them separately, that they are property held for sale. And the reason is the main focus of that is to measure liquidity, evaluate liquidity. Like when you're preparing the financial statements, the reason why you're showing property held for sale is for the reader to evaluate liquidity, that you have properties that will be sold. So if you have a governmental fund and you're holding an asset held for sale in a governmental fund, I honestly don't know under what standard this is being accounted for. I cannot think of the standard that actually allow you to do that. Because when you purchase an asset, you have to make that decision per GASB 72. Is it an asset or is it an investment? If it's an asset, it's not going to be in your governmental funds. You're going to report capital outlay. If it's an investment, sure, it will be in your governmental fund as an investment. But then it has to be measured at fair value, not at historical cost. So the tricky part about this statement is that it asks you to reevaluate that every year. So the question in the basis for conclusion was, what about the ones that already have asset held for resale? And GASB's position was, well, part of remeasuring and evaluating every year, that if you look at those assets that you had from 20 years ago and they don't meet the criteria to be held for sale, then you have to remove them and not report them as held for sale. And when we say remove them, it's all a note disclosure. You're never supposed to have them on your fund, governmental fund financial statements to start with. Because whether they're capital assets, whether held for sale or not held for sale, they are capital assets. They're not supposed to be on your fund financials. So if you do have governmental fund financials with asset held for sale, I think that's going to be an issue, and you're going to have to restate your financials to remove those and put them as government-wide capital assets. Obviously, on the enterprise funds and on the successor agency funds, it wouldn't have an impact, a restatement, but it will have a classification adjustments because, again, there is no line item on the financials called asset held for sale. There shouldn't be one. They're all capital assets. Only in the notes to the capital assets you're disclosing which ones are held for sale. So FASB requirement actually is that the asset has to sell within the next year. So GASB was more lenient and said, no, as long as basically it's likely that this will happen. So what if it doesn't happen? You have to reevaluate. Obviously, if you had an asset sitting on the books, for, like I can think of several of my clients, City of Ontario, for example, they have a lot of asset held for sale. That's going to be a big one for them because they are buying a lot of properties for development. It was the purpose of reselling it to developers. So there will definitely be evaluation there. Were those really investments or were they capital assets? So again, it's people saying that 104 is mostly about the disclosure of the capital assets, but this one I think is going to be more impactful than just separating leases and other stuff. Factors to consider when evaluating whether it is probable that the sale will be finalized within 1 year include but not limited to the following: whether the asset is available for immediate sale in its present condition. Because if you're putting something, oh, I'm going to be held for sale, and you basically have all sorts of contamination that you have to clean up and that is not really ready to be sold as is, then it does not meet the criteria. Whether an active program to locate a buyer has been initiated, which may include the asset being put out to bid, that's a good indication that the asset is being held for sale. Market conditions for selling that type of asset. If nobody's buying this kind of stuff, it's probably not going to meet the criteria. And then regulatory approvals needed to sell the asset. If you don't have the regulatory approval that is needed, then it also does not meet the criteria. But if all the assets, if all the criteria are met, then you can basically, well, I don't say all the criteria, but those are the factors that you would consider. If some of these factors are met and you determine that, yes, it is likely that this asset will be sold in 1 year, then you will have to disclose that in the financial statements. You will not remove it from your capital assets. You will, if we're talking about a building, that building will still be reported as building in your capital assets, in the capital asset note. But after the capital asset note, you're going to have another note called asset held for sale, and you're going to describe that building as one that is held for sale. So a government should evaluate whether a capital asset is a capital asset held for sale each reporting period. So that means things that you bought from 15 years ago, you have to evaluate them every year. a capital asset held for sale should continue to be reported within the appropriate major class of capital assets. So not because you determine that a capital asset is held for sale does not mean you change any of your accounting. It's still a capital asset. You still take in depreciation. Luckily, most clients we have, the property held for sale they have is land. So the adjustments will be easy. Because if these are assets that are supposed to be depreciated and they're not depreciating them because they're saying, well, it's being held for sale, that's a problem. That they're going to have to do a restatement to also reflect all the depreciation that should have been taken all those years where the asset was sitting there. And then no disclosures of capital asset held for sale, separate disclosure of historical cost and accumulated depreciation by major class. So this is not like GASB 34, meaning you don't have to show beginning balance, additions, deletions, ending balance. You just have to show the ending balance, that I have this asset with an ending value of this that is being held for sale. The carrying amount of debt for which capital assets held for sale are pledged as collateral for each major class. So if this asset that you're trying to sell is also a collateral for a debt, you have to say how much that debt is. And then the disclosure should be made for both governmental and business type activities. This is how your capital asset note disclosure would look like, where you will see here lease assets under the capital assets and subscription assets. And then under the accumulated depreciation, you will see leased assets and subscription assets. I mean, I would have called this this is, by the way, from the GASB. So I didn't do it. But if I'm preparing it, I would actually add here depreciation and amortization, because leased assets and subscription assets do not depreciate, they amortize. And then this will be the disclosure for the capital asset held for sale. That you can see here, included in the capital assets are buildings that are capital asset held for sale. They are reported in the governmental activities. They have a historical cost of 8 million and an accumulated depreciation of 5 million. And they are pledged as collateral for debt with a balance of 1.5 million. So that's basically the disclosure that you have to have for an asset held for sale. And that's it. This is a listing of everything that GASB is working on currently. Standard settings are the ones that you should expect to see soon. That basically means that they are working on the standard, and the ones that have exposure draft, that means that they already sent those drafts for input. So they normally send them to people like us, and they ask for our input. Final document, meaning that it's basically getting ready to be issued. And then these are the things that they're going to be working on. Post-implementation review normally are existing standards that they review the impact. And they try to determine whether it was a good standard or not. So that's basically everything that GASB is working on. And that concludes my presentation. I know we're 20 minutes late. Sorry. Any questions before we break? And yes, we are recording all the presentations, and we'll be sharing the link with the recordings to all the attendees. If no questions, we can take maybe 10-minute break. And I think we have some sugar you probably need. And then Mitesh will finish the day. So let's take 10 minutes and come back at 3:15. Thank you.